Welcome back to Market Day Report. I'm Scott Shelley. Happy Friday morning to you. What a week it's been. Yesterday, we had a lot happening. Today, the markets, I look at them like a living, breathing thing, and it just kind of it feels like we're taking a break here, right? We sat down on the bench, kind of catch our breath because the markets are all a little bit negative, and I think that's just due to the fact we haven't had any new bullish news. That's what the market needs. Bulls need to be fed every day. We'll see what we've got going on. So far today, let's take a look at that corn table. Corn is going to be a little easier here across the board. 4 3/4 cents lower in the September at 5.53 1/4. That new crop D's hanging around that 5.50 level at 5.50 1/4, down 6 1/4. So again, taking a breather in the D's corn. How about soybeans? This soybean chart brought to us by Bar Chart. August down 11 cents at 14.23 1/4. September down 14.5 cents at 13.70 3/4. And Novi beans bringing up the rear, down 14 3/4 at 13.63. Looking for a close above that 13.80, which was the high today, 13.80 3/4. Keep an eye on that as the session goes on. How about wheat? The wheat board. Wheat table looks like this: 6 3/4 cents lower in Chicago, 6.98.5 in that September contract. December Chicago, 706.5, which is down 7 1/4. Moving right along out to Kansas City, the hard red wheat in Kansas City, 6.5 cents lower at 6.68 in the September contract. December bringing up the rear, 6 1/4 cents lower at 6.79. How about Minneapolis spring wheat? Minneapolis is going to be lower again as well. This is the volatile one here, folks. It's down 12 cents in September at 906.5, 11 cents in December at 892 1/4. And I'm lucky enough to start the day off with Brian Hoops from Midwest Market Solutions. Brian, thanks for joining me. Thanks for getting this day rolling. Kind of summarize yesterday and then give us a game plan for us today.
Yeah, good morning, Scott. Yesterday's trade, we saw some higher prices. We saw, some buying interest coming into the Minneapolis contract, but not a real great close, I didn't think. And now we've seen the markets pull back on some technical weakness. We failed at resistance. You kind of hit the nail on the head that we just don't have a lot of news right now, and the market always needs to be fed some bullish news to move higher. It seemingly can move lower on very little news, and that's what we're seeing overnight. One thing I am talking with clients a lot about here is the U.S. dollar index. It seemingly has broken its uptrend, and you and I have talked about maybe some weakness coming into this economy. I view that as a reflection of the economy. The dollar's starting to weaken just a little bit, closing below its 21-day moving average for the first time in several months. And we're seeing a little bounce this morning, but the overall, the trend could be working lower, which is to the benefit to our commodities.
Right. You win the prize, Brian. I mean, I love it when somebody brings in the outside markets like that, and it's really important to know that with the Fed, what they had to say on Wednesday really made it look like they're going to continue cheapening that dollar. And if that dollar does continue to get cheaper, the old lows are around 89 and change. Keep an eye on that. We dipped below that 92 level there. You just saw the chart. So that's going to be a really important one. It's not a massive, massive driver. Obviously, weather is, but boy, oh boy, it can really help when you start to see that dollar tank. And if you see us make new lows, I think that could be very inflationary. That's that inflation word coming back in again. So we'll stop right there. We're going to take a quick break. We're with Brian Hoops. We'll come back after these messages to talk about that livestock market and see what we've got. We're getting ready for the open. Well, good Friday morning again. Welcome back to Market Day Report. I'm Scott Shelley, otherwise known as the Cow Guy. Let's see, the livestock aren't open yet. Well, let's see how they went home last night. Now, I reckon we might get a little strength out of these markets with what's been happening over with the grains and oilseeds. But let's take a look how we finished up the day in live cattle yesterday. It was a quiet day, as you can see by the price action here. 57 cents lower in the August contract at 122.50. October went home 37 cents lower at 128.15. And then December followed up 22 cents lower at 133.27. Feeders also a little bit easier yesterday, but a little bit more than the live cattle. 167 off in the August contract at 158.50. We were off $1.50 in September at 161.95, and then October was 137 lower, $1.37 lower at 164.20. We had a lot to talk about in lean hogs yesterday with this ASF, but they held in there. We had a mixed board, 60 cents higher in the August at 106.30. Now, 2 days ago, or October was limit down on Wednesday. Yesterday, it kind of lost a little bit more, 55 cents at 88.97. but we did see December hold in 25 cents higher at 82.40. We still have Brian Hoops on the phone with us. Brian, can you make any sense of these proteins for us today, what we might expect here on the open?
Well, I think we could see a little bit weaker opening in the cattle market with the stock market being down, Scott. We've been talking for at least a week now before the cattle on feed came out that if you get some bullish news from that report, we would recommend to use that as some hedging opportunities at a minimum, buy some put options and reduce some of the risk. You're at really high price levels here with the market anticipating cash is going to come up a significant amount by the fourth quarter of this year and into 2022. Now we talk about the economy starting to weaken, and maybe that affects the cattle market, it affects hogs as well. It certainly could. We don't expect to see a real blowout or a washout, but we certainly could see a big pullback from these high price levels that we're at, and that's why we wanted to get some hedges in place and have been recommending it. Last 3 days, from a technical standpoint, we've given back some daily gains by the end of the day, suggesting that there's been some selling, maybe some commercial type hedging that's coming into the markets near the closing bell.
Well, you know what? Again, you're 2 for 2 because you brought up those markets. And yesterday we had some not so great news. I mean, I guess it was less strong, right? With GDP, we're expecting an 8.5% print. We got a 6.5% print, which is pretty disappointing. And then we had jobless claims come out higher than we had expected, twice as much as we had pre-pandemic, and about 50,000 more than we've seen on a 4-week rolling level. So with that, you might think that you've got a few more nerves kind of coming in and saying, you know what? Yeah, a 6.5% GDP number is not bad. It's still good. It's just less good than an 8.5% GDP. And then how could that then look at demand going forward? And if things do start to cool off here, and when we're expecting, a rip your face off, quote unquote, economy, I think that could be one of the one things that could derail this demand situation. What do you think?
Yeah, I totally agree with you. It could really hurt things here. In the market, like I said, it's built in a premium, anticipating we're going to see these higher prices. Producers' standpoint, you need to take advantage of that opportunity. With the markets anticipating a $14, $15 gain in cash markets, why not lock that in, or at least a minimum, use some options to allow yourself to have more upside potential, at least have that locked in.
All right. Excellent stuff today, Brian. Thank you very much. Have a great weekend. That's Brian Hoops, the president of Midwest Market Solutions. I'm Scott Shelley, but we're going to hand it now back over to Tammy.